Cool. All righty, guys. Thank you all for coming. This is the second time that we have done this with Ryan Rocha, accountant in the DMV area. My name is Cassidy Burns, and I'm the owner of BPG Residential. We do residential sales, property management, asset management and holdings, as well as we have a construction arm, AVEC Construction. So we do these every single month, and now we've just started a breakfast meetup as well. The first Tuesday of every month, you're welcome to come. That is going to be from 10 to 11:30. So the reason we do these is, one, for education, but two, it's so you can meet and interact with other individuals that are in the business, that are doing business, so you can grow your business and grow your network, so you can continuously do deals, right? So when you meet individuals here, don't just leave. You need to get their information, follow up, take them out to coffee, learn from them, and start doing business with them. So one thing we like to always do is, who here is doing fix and flip real estate? All right, fix and flip. Yeah, he's doing one in Richmond. Who here is doing buy and hold? Who owns rental properties? Great. Who here is in property management? All right, great. Who here is wholesaling deals? Who's here is a real estate agent? Who here is a lender? And then we have our two accountants here as well, right? So you saw everybody's name and hands up, right? So please interact with them after this, right? And this is going to be a very interactive session, right? Taxes is a very complicated thing. It's not about what you earn, what you make. It's about what you keep, right? This is all about keeping the money that we earn. And we're going to utilize real estate to do it. So we're going to be talking about depreciation at first, and then we're going to open it up to questions, because everybody's situation is different, right? Whether you own 0 and you want to find out how it's going to affect your tax basis, or if you own 100 and you want to know, maybe should I be doing cost segregations on those? He's the guy that's going to answer them. So thank you, Ryan and Gary, for coming. We appreciate it.
Thanks, Cassidy.
Yep.
As Cassidy mentioned, I'm Ryan Rocha. I am the managing partner of Rocha and Company, and we're located in Maryland, but we service DC, Virginia, the whole country. We've got about 3,000 clients. There's 26 of us there. I bought my tax director, Gary Walden. He knows all things real estate, and will help me out here when I kind of stumble, or you guys throw tough questions at me. I'm going to kind of just talk in generalities to start off, just so we can get the discussion going. But the last time I did this, the longer portion and the more important portion was your guys' questions. There's stuff going through your head. So I'm going to talk about some things that'll get your brain going and get you thinking about real estate questions that you have, and maybe pique some interest in some things that you want to talk about. That's really where we're going to spend the focus of our time, because this is about you guys and the questions that you have. This isn't about my knowledge in doing this. I've been doing this for 30 years, had this firm for 15. So I know a lot about this stuff, but I don't know what affects each one of you guys and what your questions are. And that's really what we want to talk about today, is what affects you. We've got different kinds of investors, different kind of things that are going on. You guys may have things in your head that you want to do, you want to talk about. This is the time to ask those questions and for us to answer them for you and use our expertise at doing so. And hopefully we can answer those. And if not, then we will get your information and we'll get back to you on those questions and get you some information. As you know, I'm probably not even going to follow this stuff, but as you guys know, the real estate landscape is changing, and it always is. You know, again, I've been doing this for 30 years and I've seen so much change in the real estate industry. But obviously, as we see interest rates change and you know, the market, the availability of real estate, and you see more and more people getting into it. When I first started doing this, real estate investors they weren't a dime a dozen like they are now. They were more your 30 to 40 to 50-year-old gentlemen, I'll just say, and this isn't an offense to anybody, I hope, but that's typically what you saw back then, who were buying commercial buildings. You didn't have a lot of rental investors kind of the way that you do now. You didn't have Airbnbs. You didn't have, so there was a very specific way of doing things when I first started doing this. And it was interesting because real estate was not kind of what it is today, at least the visibility. A lot fewer people in it, and more people wanted to do other things besides real estate because people were scared to invest in real estate. People thought that you had to be, you had to own 10 buildings and you had to do this in order to make your money in real estate. Well, today we have all kinds of investors. We have people that are in high school that will invest, will do certain things and try to get into it, and make money. So there's a lot of different things that we have going on. And because of that, we have to be mindful of the tax rules and the tax things that affect us and how that affects us and what we can do, like Cassidy said, keep as much money in our pocket as we possibly can. And one thing that I think I focus on right now when I think about real estate and my investors and my clients and the people that are in it is how are we looking at this? Are we looking at this from a tax perspective of I want to shelter income? I want to shelter everything I have and not pay any tax, because that's not possible. That's just not going to happen. Everybody thinks it is because they look at Donald Trump and his real estate holdings and everything else. And that's the first question I get on half of my new meetings these days is, if he's not paying tax, why am I paying tax? That's just not the right way to look at it. I think we have to look at it from each perspective. Like, what are you doing? What are you doing? What are you doing? And what is it we can do? And then get your expectation to a place where we can focus on what that expectation is and can we really in reality get there? And maybe we temper that expectation and say, this is really where we're going to be at when we get to tax time. I dealt with some of you on some transactions, and a lot of times, it takes time to develop those transactions. It's not as simple as I can get you an answer today on what we're going to do on taxes. So instead of ramble on about that, I'll start going into some specifics. If we're going to buy a home and rent it, that's going to be so much different than if we're going to buy a home, rehab it, sell it, flip it. So we've got different things going on there. And you hear words like depreciation, cost segregation, all these things that you're probably going to have questions on, and we'll answer those questions. But they only apply to this bucket over here. They don't apply to what's over here. So one of the things that I point out is when you're doing this, know what you're doing, know what it is that your objective is, because then you can focus on the tax effects of what's going to help you out there. Is cost segregation going to help you out on the rental? Is cost segregation necessary for a rental that's a single family home and that you bought for $350,000? Probably not. It's probably not worth the effort of hiring somebody to do the cost segregation. You can do it yourself. And we've actually this year started, because of all the cost segregation questions, we've developed a little format and, give it to our clients and say, here, you can go do it yourself. You don't have to pay somebody $5,000 to do a cost segregation study for you on a $300,000 house. So we have to look at those things, and maybe cost segregation doesn't even apply to you, because if you're a passive investor and you're not a real estate professional, then you may not even get any benefit out of that currently anyway. So it's kind of looking at these things and figuring it out. Now, you guys aren't going to have a lot of those answers because this is new to you on the tax side. And when I say new, just you're not experts in it. Okay, it may not be new. You may have been doing this for 10, 5, 10 years, but it's not something you're used to, and it's not what you do for a living. So, figuring out those type of things is really what you need to do, and then do a budget of some sort. Because we can go into this and say, I'm going to go buy a property and it's going to go up in value and everything else. But that's one of the myths that Gary's probably going to talk about when he talks about myths, is we can't guarantee that property's going to go up in value. And I'm sure some of you have gone through that, where you've said to yourself, how could this property not go up in value? And then it doesn't. Well, what are the effects of that? How does that help us tax-wise? We have these losses and these things. And those are all things that we have to think about. And those losses can help us so we can get something back for actually losing value on our property. None of us want to lose value on our property. We want the property to go up. But what happens when it doesn't? And be prepared for those things. Because where I've seen a lot of my clients have problems is they get so underwater on their real estate whether they're highly leveraged or whatever it is, and they can't get out of it. That's where you have a big problem. And when you're so handcuffed that you can't get out of that situation, you have to start selling off real estate or even foreclosing on real estate, which I've seen before. That's when you have a problem that, tax is not a problem. It sucks. I've never had a client come to me and say, that amount of tax that you just told me I'm going to pay is great, Ryan. That's beautiful. If it's not zero, then it's never a positive number to them. But we work with that, and again, it's that expectation of what is this going to look like to you. So if you aren't doing it already, my suggestion is that you kind of budget out what this looks like to you, okay? And not from just the perspective of I'm going to buy this property for $500,000. I'm going to wait till it gets to $800,000. I'm going to sell it at a $300,000 profit. I'm going to have to put this much into it. Like really look long term and say that these are the things we're going to do, because there's a lot of different things that probably you guys don't know that you can take into consideration. Obviously, we talked about the 1031 with some of you guys. The 1031 is something that is useful, but what some people don't know is you can 1031 out properties if this is what you want to do long term. And I have to suspect that most of you are here because you don't want to do this for just a year or two. You want to do it for a long term effect. But you can 1031 out a property, hold on to it to when you pass, and that's just as good an asset for your kids as a pension is. In fact, it's better because you don't pay tax on the increase in the fair market value of that house. So if you bought the house at 500, that house goes up to $1 million. You 1031 it all the way out to that $1 million. Your kids are going to take it over at $1 million when you pass. None of us want to think about that. We want to think about passing but if we're going to pass assets along to our kids, whether it's cash, whether it's pensions, whether it's real estate can be one of the best things to pass along to our kids. So you don't just give up when a property goes down in value. You can hold it for long term and have other options, but you have to be thinking about that. You have to say that this is the end goal of doing that. So it's thinking about those kind of things and taking that into account when we're doing this. And that can apply to a rental, that can apply to a flip that you're not able to flip. Flip by nature is something you're turning around, but if you can't. So all these things can come into account here. I mean, you can do commercial properties, and we all know, real estate investors with commercial properties usually hold those for a long period of time. So those are the kind of things that you guys should be thinking about as you're doing this, and the kind of questions that you want to ask us specifically about some of these things that I talk about, the 1031 and holding a property and getting that step up in basis, because there's other ways to get step up in basis and increase the value of your property so you're paying less tax on it. We're never going to be tax free per se, besides the 1031 exchange, but we're never really going to be tax free on these transactions. It's just hedging, what you're doing, because if you have multiple properties and you're putting a lot of money into one property, but you're getting ready to sell a property at another property at a profit, then you may say, well, I'm going to take some costs from over here and put them over here. Now, I'm not telling you to do that, because technically that may not be the right thing to do, but it is something you can do and kind of take this into consideration and do some planning when you're dealing with all this real estate. The real estate does go into different buckets. So if you have multiple different types of properties, then you have to weigh that as well. And I'll just give you an example. And again, I'm not telling you to do this, to go out and do this, but you buy a property, you have furniture in that property, and you're rehabbing another property and you're getting ready to sell it. Well, maybe you pay for some furniture over here, but you allot it over here. And that way you're deferring your income because you've taken $20,000 of furniture, fixtures, and over here that you bought. Well, you haven't done anything with that property yet, but you sold this. You allot some of that cost over there. Again, not telling you to do that every single time, but something just to think about, because when we have salaries and we have other things that we have in our life that are not real estate related, we're trying to defer that income through 401ks, other avenues that we have to defer income. We want to figure out how to do that in real estate. And again, that's hedging all the different things that we have and kind of going through that.
So I'm going to throw out a few questions. So I know that was a lot, right? Taxes. Woo, right? So a few things. Who knows what a cost segregation is already? 1, 2, right? So a cost seg is accelerated depreciation. That's the simplest definition that you can do. Cost seg is accelerated depreciation. Who knows what you can depreciate? How many years can you depreciate a single family home over? Got one?
27 and a half.
27 and a half. Great, right? So that's great baseline information to know. So whatever your basis is, divide that by 27 and a half, and that's what they can depreciate over on your tax returns, right? So a little bit different, right? When you do a cost segregation, what types of properties are you typically doing a cost segregation on?
So when we're doing the 27 and a half, we're doing it on the building. So most people are just going to put on a tax return that they have a 27 and a half year depreciable building. Okay. And if you buy for 275,000, yeah, I mean,
yeah,
so you get 10,000 a year, so it's thinking about that. And that's not a very big deduction to get on a big property. So what Cassie's getting at is there's certain things in that house. There's cabinets, there's refrigerators, there's washers and dryers, there's, flooring, there's just lamps, all kinds of stuff that you buy in a house. If we, in the segregation is we take that stuff out and we put it into that bucket, we can now depreciate stuff at 7 years, 5 years, which is much better than 27 and a half. And we could even get accelerated depreciation, which is what they call Section 179, or just the bonus depreciation. I won't go into all the specifics of that, but that could allow you to get the full value of that item. So if you have $1,000 refrigerator, you might get $1,000 deduction in that year. Imagine taking something that's $1,000 and depreciating it over 27 and a half years.
Pennies.
Yeah, it's going to be on pennies. So the cost of segregation does become important, but it becomes important on a bigger property, a multi-unit or whatever else. I don't say don't do it, because I just had a client that they bought a $280,000 townhouse, and we did a cost segregation. It was a fast, easy one, but we did it, and they got an extra, I think it was about $15,000 in depreciation in that year.
And probably because they needed it. So that's why you decided to do it.
Yeah,
It was dependent on their situation and their plan.
Right. For most people, it is. In this case, it was two doctors.
Got it.
They were passive investors, so they're carrying it forward anyway.
Of course.
That's a whole
So if
nother
you're
thing.
already in a loss.
Well, it depends on so that depends on if you're active or if you're passive.
So you're passive.
If you're passive, then you're just carrying forward more loss now. But it will, and this is going to get confusing, it will, because you're taking ordinary loss, so ordinary income items, which you're taxed at, whatever your tax rate is. Let's just say it's 24, 32, or 35, or 37. Okay, your capital gain is going to be a lower rate, either 15 or 20% plus the 3.8 net investment tax. So your max is 23 versus a max of 37. You can offset those losses, whether you're carrying them forward or taking them now, against that higher tax, whereas you're going to have capital gain on the rest of it. And the capital gain is going to be taxed at a lower rate. So even if you're not, per se, getting a tax benefit from it right now, you're going to get it down the road in either a lower tax rate or no tax. And that's what you're trying to do with the cost segregation, is accelerate that and then put it into a bucket where you're not paying capital gains, where you're paying capital gains tax instead of ordinary income tax.
Can you only do that in the year that you purchase the property?
To some extent, yes. You want to set that up front. So you don't want to sit here and change the building and say, okay, but you can. Okay, you can. There's no rule that says you can't do it 5 years down the road if you want to. And some people, it's tough for them. First of all, you're buying a property, and if you buy it in December, you're doing a tax return right after that, and you're just not thinking about it. And then all of a sudden, somebody starts talking about cost segregations, and now all of a sudden, you're saying to yourself, cost segregation, that sounds like a great thing. So you can do it, and you can reclass that stuff. It's just odd. It's very odd, because once you start depreciating that building at 27 and a half years, you're not all of a sudden going to change things, and you're already down to 20 years left on it or whatever. I mean, but it still pays to. It still pays to do that. The IRS is, and you're taping this, aren't you?
Yeah.
I was going to say, the IRS.
3 different cameras.
Okay. The IRS is not sophisticated enough to pick up on that. So you have to get it audited for them to do it. And then if you're audited, I know we would be able to explain it to an auditor and get them to buy off on it. Now, if they came to you and said, well, why did you do this? You're not going to have a very good response to that, probably. Yeah, you're going to be like, well, I just heard this guy talking, and he said to go ahead and do it. He said the IRS isn't very sophisticated. Who was that? So, no, but they're all good questions, and every situation is different. So whether you do that, if I own a $10 million building, 5 years from now, I wouldn't mind doing a cost seg study and getting that to fly.
You said there's a cost seg Excel file on your website, or do we get?
No, it's not. I mean, I have it and I can give it to you,
Okay.
but it's not something we just share. We put
so what's
out
the protocol for?
If you just give me 10,000 cash, then I.
It is
No questions asked.
It's for sale.
No. I'm not that kind of guy.
Yeah.
I'm not that kind of guy where everything's done for money. No, if you either me or Cassidy, if you reached out to us and say, hey, can I see that? Then we'll set it.
Because I'm set to close on the 6 unit in DC
Okay.
in April, and I think that'd be super helpful.
Yeah, it's nothing sophisticated. It's pretty simple. It's just, but it gets your brain going. And a lot of this stuff, just like I said before, I'm going to talk about some things and get your brain going. We've already got a bunch of questions, and that's the kind of stuff. So yeah, it'll certainly help. It's not going to be, I can't guarantee it. If you go into an audit, it's going to be what you're going to use and what you're going to put forth. And we've developed it off of various cost seg studies that we've got from engineering and, finance professionals. All right, any other questions before we kind of move on? Okay, here's the other part of this that I think is important, that when we do all these things, no matter how much we know about real estate, no matter how much we think we know about real estate, probably the most important part is really keeping track of this stuff. So what we call bookkeeping, record keeping, is very important, because we don't think about some of the things that are on that closing disclosure. We don't think about some of the things that are done before we buy the property, some of the research that we're doing, some of the mileage, the travel, some of the things that mileage to come here and learn about this stuff. All this stuff becomes important to the cost of what you're putting into this, because there's a hidden cost that each one of us puts in to what we're doing in real estate that's important. So record keeping becomes very important, whether we're tracking that on apps, whether we're using Excel, whether we're using QuickBooks. We're all at different levels. So the simple investor doesn't need QuickBooks Online to manage all this stuff. And then it also depends on whether you have multiple LLCs and multiple units and all this different stuff. But just something to keep in mind, because people always come to me and they say, one of the first things they say is, Ryan, how do I lower my tax? What can I do? What kind of shelters? That word drives me nuts. But, people ask me, but it's a legitimate, the way that they say it to me. But, it's a legitimate word to use in it. But I don't have any shelters. I don't have anything, in here that I can grab and say, here, take this. Here's a ticket. You don't have to pay tax in this year. There's nothing like that we're going to have that's going to help us get through tax. But what we do have is what we're creating: credit card statements, our records, our books and records, what we're doing, and that's the best source of getting your income down. Because if I have a company, whether it's real estate or not, if you make $100,000 and you pay tax on $100,000, people come to me and they say, "How do I get my tax rate lower?" Well, if you're paying tax at a 37% rate on $100,000, your tax rate is going to be 37%, and you're going to pay, $37,000 in tax. But if you keep good books and records, and you can substantiate $40,000 in deductions, now all of a sudden you're paying 37% on 60. I'm sorry, my math's bad. But you're paying 37 on 60. That's a lot lower rate on that same amount of income, because you've kept good books and records. So that's something that I tell people all the time, is don't come to me and say that you have this business and you want me to do certain things to shelter the income. You need to tell me what expenses you have and keep good books and records. If you do that, you're capturing all kinds of different stuff. You're capturing home office, you're capturing travel, mileage. A lot of people lose mileage because they don't think about it. They're not keeping it anywhere. And so if you capture all this stuff, and I do it for my business, I actually do my own taxes. I do my own books, but I make sure that I think about all these different things that I'm doing, no matter what I'm doing. If I'm down visiting my daughter at South Carolina, at the University of South Carolina, where she's at, I'm taking phone calls about business. I'm down there, I'm dealing with people on business. I'm taking some of that cost as a business deduction. Sure as heck going to take my flight down there, and these are the kind of things that you have to think about. Now, you're going to hear a lot of people on the internet, wherever else, and they're going to say, do this, do that, do all these different things. Just like I'm kind of saying right now, you kind of have to pick and choose what you believe to, because the IRS is ramping up their efforts to look at stuff. So what I've heard from my clients that come in and say, well, no, this accountant told me to do this, or this person told me to do that. And I said, that's not a terrible idea. But I said, the reason you're being told that is because nobody ever got caught. Okay, when you hear your friends say, no, I'm doing this, I'm doing that. And I'll give you an exact example, and this is an absolute true story. I have a gentleman who's doing construction, so it's a little bit real estate related. He's doing construction, and this gentleman is from a faraway country, came here and really didn't have a dime to his name. And now he literally last year made $9 million doing in his construction company. Okay, he made $9 million, not grossed. Okay, he walked away with $9 million. He took 7, 8 of it out of the company and bought real estate. So bought some rentals, bought some things at his house where his wife wanted some houses and things like that. And I said, are you crazy? You've got no money left to pay taxes. Do you realize that on $9 million of income, you're going to roughly pay $4.5 million in taxes? He's like, Ryan, I don't have $2 million left after buying, because he bought them for cash, because this is when I'm talking about real estate landscape changing, because he didn't want to pay 7-8% in interest. So he said to me, well, Trump, and you know what I said before, Trump isn't paying in tax. And he said, Ryan, I've talked to billionaires who tell me they're not paying any tax. I said, excuse my language, but I said, that's bullshit. They're paying tax. And if they're not paying tax, they're doing something illegal. Because people have this, because they hear that so-and-so's doing it, so-and-so's doing it. And this is not the first wealthy client that I've heard this from. My millionaire or billionaire friends, they're not paying taxes. That's just not true. And what's happening is they're doing insurance captives. They're doing these crazy things, buying airplanes, and I went to a party in DC for a lobbyist firm that I do work for, and the owner was drunk, and he's like, Ryan, you got to tell me how to buy a helicopter. We want to buy a helicopter. We want to buy airplanes. And I said, you're drunk. We'll talk about this later. But, those things don't necessarily work. Like, if you're going to buy an airplane in a vehicle, in a company, it's got to have it's got to have a legit. You can't just go buy an airplane and say, I'm going to deduct a $2 million airplane, unless you're drunk. But, it's just these kind of things, you just got to watch what it is people are saying, and you've got to apply it to something that's real. Because for years and years and years and years, and I'm fortunate, I'm 52 right now, and I'm on the second half of my career. So the first half of my career was based off of this time when the IRS just wasn't auditing. They weren't. We have 3,000 clients, so we do 3,000 tax returns per year, and and Gary can attest to this, I'm being totally honest when I say we have 1 or 2 clients audited per year. It's not because we're the greatest firm on earth. It's just because that's what the IRS does. They don't have and now that's changing. And in fact, we just lost one of our employees to the IRS to go to the audit division, which is good because we'll have our end. But at the same token, the IRS is ramping it up. So we're now going to see these people who are saying, you can do this and you can do that. We're going to see who's real and who's not. We're going to see which ones stand up. I like to think that all the positions we take are going to stand up, but I bet you at some point in time, some of them aren't. And then we're going to come back to you and say, remember I told you to do this? Remember I told you to take that furniture from that one house, put it over here? Don't do that. This guy's in jail. So, those are the kind of things that we have to watch as well. So when I say the landscape's changing, it's not just changing real estate, it's changing with the IRS. And then that causes changes, and that causes us to look at things a little differently and say, this is what we need to focus on. This is what we need to, and it comes down back to you. What are you doing? What is it that, where do you want to take the risk in the gray areas? Like what is it you're doing? So it's kind of looking at that, and the books and records, everything that you're doing all add up to get to this point where we're in the best position possible. And this is my pain threshold. This is what I'm willing to do, but listening to the right people too. And it starts with you. If you go into this and you say, I don't want to pay any taxes, I'll do anything not to pay taxes. That's not the right attitude, because that's just not going to happen, and you're going to end up doing something because you read it online or whatever else. So that's, on those things. And Gary will get a little bit on that when he goes over myths. I don't want to talk too much longer. I've got a million things I could talk about here. I want to get to your guys' questions, answer your guys' questions, because that will get us back to what you want to hear, and kind of we can go from there. Anything else that I think is, we talked about expenses. What you guys do, a lot of what you do is marketing. And so there is a lot that we can deduct. So when clients come to me and they say, Ryan, can you give me a list of what I can deduct? There's so many things that can go on that list. It's kind of like asking for the cost segregation thing. Like, there's so many things that you can put in there. We can deduct almost anything in our lives, especially when we're fully involved. Cassidy, everything he does is real estate. So there isn't anything he doesn't spend money on. But, you can kind of think like those clients when they come to me and they say, what can I deduct? I'll say, here's a general list of what you can deduct. And we do have something too for that we get an Excel schedule that tells you generally what the expenses are in a business. So we do have something like that, but that's not it. When you get into this and you guys become more experienced at what you're doing and really have this all down, you're going to realize that when you go out and you have 2 credit cards and you have one's personal, one's business, you're going to say, I'm pretty sure I can take this for business. And as Gary says all the time, leave that to us. So you can put it on the business credit card. You can try to take it. And if we think it's something you shouldn't be, like a, Lamborghini, or I do have a client, years ago, about 20 years ago, that got busted, and he got audited, and he had deducted his mom's deck that he put on her house, and then a Harley Davidson, and both were disallowed. And he didn't, the thing is, like, he didn't go to jail. Like, it's you look dumb in an audit when you do something like that. And I felt that it was my business partner that was doing the audit. So I felt bad for him because he looked dumb for letting him do it. But, it's not a good look. I've only seen in my 30 years of doing this, one of my clients almost go to jail. So, and it's probably one too many, but it was something he had done, not us. But so don't worry about that. It's more so the effect that it has on you mentally if you do something that you shouldn't be doing, and then the effect it has on your future, because then you become tentative. All right. We're going to answer all your questions here in a little bit. I'm going to let Gary kind of take over on some of the myths and some of the things that are out there right now that people hear, and then you'll tell us about the real myths that you're hearing with questions. But we'll answer your questions here in a little bit, and we'll spend as much time as you guys want on questions, because I'm sure each one of you has some questions about things that you either came here predisposed to talk about or things that we've talked about here. Take it over here.
I'm Ryan's tax director. I'm the old guy. And you're about to see why Ryan gets invited to parties and I don't. All right, let's jump in. Somebody said 27 and a half years. That's brilliant. Let's change gears a little bit. Look at this building. I'm going to come back to cost segregation for a minute. If we look at our tax return program and we're looking at this building, what do we see? We see two entries, building and land, no depreciation, everything else. Whether it's 27 and a half, whether it's 39 for this, it's a building and everything in it. Myth, cost segregation is overrated. Wrong. What is in this building? Not just lights, fixtures, furniture and fixtures, but there's copper wire, there's a patio, there's a fence out back, there's all these things. Why would this be important? I'm going to come back to something you said. You made a great comment. I want to come back. Why would a cost segregation work? Time value of money. Time value of money. Why should we wait, whether it's 27 and a half years or 39 years, to get a lot of this money back when we can be using it right now? We may need that higher depreciation to avoid taxes. We may need, for some of you in here who are real estate professionals, we may need that depreciation to create a real estate loss that you can use to offset other income. Wonderful. Well, Gary, you just said cost segregations make great sense. When do they not?
You're in a loss already?
When you can't use them. When you can't, why should we go out and pay to have a cost segregation study? Why should we expend the effort? Why should we do these things and we can't use it? Maybe we're a completely passive investor. What good is this going to do us? And we have all the time. Clients come to us, I want to do this cost segregation. I want to accelerate all the depreciation. It's going to save me taxes. No, it's worthless. Ryan made a good point. You got to figure out what's right for you. I want to talk about another myth, IRS audits. We always tell people, and he's tired of me saying, you got to look at this how the IRS looks at it. How would they look at things you're doing if they called us back? We did this. We did a cost segregation 5 years after acquisition. Okay, so we've got to take the 27 years and back out some things and do the math, and we'll figure it out and we'll document it. And I got two things. One, I'm full of it, bravado. It's just a math problem, and we're good at math. But the second thing is, what would we tell the IRS? It made sense for us. It didn't at first, nor did I have capable, competent help to get me here. But guess what? I heard someone say this, and damn it, it worked well. When you go to approach the IRS, having everything documented, you can't imagine how important that is. We spoke a little bit about tracking expenses, whether it's QuickBooks or Excel or it's notebook paper. Track your expenses contemporaneously. Get those in there and keep that going. Because at tax time, repeat something, everybody and their dog comes to us and say, here's my stuff. How you gonna save me? It's too late.
Sorry.
It's too late. It begins up front. So when you do here is kind of talk about, let's look at 1031A exchanges. Who in here have I bored to tears? I don't want to name names, Evan. That would be indiscreet, but who have I bored to tears with 1031A exchanges? There's a lot there. You can read up on it. You talk to your brother-in-law. That's fine. A little bit of conversational fluency. But when we get down to your numbers, it's going to get real tight, and we've got to make sure it works for you, whether it's cost seg, 1031. Forget everybody else. Forget the person next to you. Does this work for you? Tracking expenses. Does QuickBooks works? Guess what? We've been doing this a long time. Ryan knows QuickBooks well. I don't. No need to. Excel is fine. A few others. Past performance predicts future performance. Throw that away. Anybody in the lending turf right now? Whoa. Rates have been 2-3%. So I could come to you right now and I want one of these too, right? No, of course not. Real estate commissions, that's also flipped a little bit. How we look at Airbnb income versus traditional rental income. A lot of people would say, hey, Airbnb, it's rental, 27 and a half years. Not anymore. 39 years because it's a short-term rental and it's deemed a commercial activity like this building. All of a sudden, we're back at 39 years. But then we can do some other thing. Furniture and fixtures, 7 years under rental, but 5 years under commercial. Everything will change. Future performance. If you're not doing a plan or having us do a plan, because I can tell you IRS has a plan. They didn't invite us. You know, we've got market conditions changing. We've got commissioner. Everything's changing. If we're not, or you're not planning out things for the future, where this is going and what could come up, it's not going to bode well. We need to know where this is headed. What losses are we going to get? Can we use them? Can we take them? Brings me to my second point. Real estate's a passive investment. It's a passive activity. Sometimes. Bear in mind a few things because the law's changed a little bit. If we have a client right now who owns rental property in the United Kingdom, he does not live there. Can I take the losses? No, you can't. Why not? Because you're not actively involved in it. Someone else is. You can't even spell UK, all these things. Great. Yes, he's removed from it. But active involvement in real estate can get you up to $25,000 in losses to take against other income. There's an income threshold where that stops. That's at $150,000. And a lot of people will, especially here in the Metro DC, will pass that income amount real fast. So, well, even though I got these losses, guess what? We can't use them anymore. Now what do we do? But what if you're a real estate professional? On your internal revenue code 469C7. See, I told you I could be boring. The law says that if you're a real estate professional, and they define that, 50% of your activity is in real estate, you're using 750 hours on this, all those losses you can deduct, and they're not capped. Oh, this changes things. A few years ago, the law changed and it said, this handsome gentleman and I are married, right? And I'm a doctor. And the spouse doesn't work. But if I own all the real estate and I can't touch those losses, but my spouse is a real estate professional, guess what? We get to take all the losses. So sometimes we even come back to our clients and say, would your spouse be interested in going through the motions of documentation? That's really all it is, so you can get these losses. And the person says, oh, he or she would love to. They're like, no. But the thing is, it's not always passive. I love that this is a bad word in English. It's a good word in French. Discriminate. Discriminate on your activities and see for yourself, could I qualify as a real estate professional? And I know several in here, the answer is yes.
I have a good question just because on this topic. So let's say you make a salary, you're a W-2 employee, but then you also manage and own, say, 20 units. And you're somewhere around 750 on an annual basis. Like, how do you get comfortable with saying you're a real estate professional or not?
Well, you have to be 50% or more in real estate. So if you have a full-time, so it depends on what your salary is, it depends on what your job title is. I've had people come back and say, so most people, if you have a full-time job, so how can you have a job that takes 2,000 hours and then have another? It's impossible to have something else that you could have 2,000 hours in. I mean, it's almost virtually impossible.
Well, so 750 hours a year, that's about like 14 hours.
I know, but you have to be, the other part of that rule is the 50%. So there's two parts. There's the 750, but then you have to be 50% or more in real estate. So if you're IT guy working for, whatever, IBM or whoever, you've got 2,000 hours. You're accountable to IBM for 2,000 hours. Even though you have 750 over here, that's not more than 50%.
Mm-hmm.
So you wouldn't qualify. Now, the only time I've seen somebody get away from that is somebody who's, and this is again, we're stretching it, but somebody said, oh, I work for the government. They don't, so half of my time, half of my day is spent doing their stuff, and because I'm working from home, they don't see what I'm doing. I'm doing the other half real estate, and this is a true story. That's what you.
Literally, I work for the government.
Okay.
And I have a hybrid schedule, so like I work
Yeah,
at home and I work in the office. I can tell you, I'm spending more than 14 hours a week on private real estate. So.
Okay, so you.
But I couldn't look the IRS in the face and say that 50% of my time.
Comes down to the amount of risk that you're willing to take.
Yeah. Yeah.
When it comes down to these real estate professionals, there are very, very clear rules. 50% of your activity, it's an and, not an or. 50% of your activity is on real estate, and it's at least 750 hours.
And then I work in housing policy in government, but that's still, even though it's real estate, it definitely wouldn't qualify. I would have to say,
It's risk.
oh, well, on days that I work from home, I'm actually doing more real estate stuff, so it's closer to 50-50.
But that's a good point, because if somebody's a loan broker or somebody's a construction person, so you have to learn what's going into that. It doesn't have to be somebody who just owns properties. You could have something else in real estate and it could qualify you. So you do have to look at that. Yours is probably not.
Yeah, I wouldn't expect it to. But it's curious.
If it's the minimum of 750, why don't you say 1,000 hours? If you got 2,000 a year for your day job, can't you just prove that you?
Well, you have to have 2,000. So if you have 2,000 in your day job,
Yep.
you have to have 2,001 in real estate.
Oh, 50%.
Yes, yes.
Not 50% of your
That's
whole
100%.
Well,
It's not
100.
50%.
Well, 50% of all your time.
Aggregate
Of
time.
all your. Sorry, it's semantics, but yeah.
Yeah.
Yeah, no,
And
that's.
this goes back to saying, well, I only work 10 hours. I only work 10 hours a week for the feds, or I work at the school or this. That's where the 750 will come in. We have clients who work for the federal government, not related to real estate, and they still qualified for the 469C7 designation. And it even went to the IRS auditor, not an examiner, auditor, and they gave it to them. Why? They had documented everything they had. They worked it. They really, really did.
And they had the real estate license.
Yeah.
So not
How
real
much
estate
extra
license.
room is
It's just-
But they had an employee agreement that said you have to work 2,000 hours, right?
Well, they could be sued by their company, sure. But
Oh.
so that's a
They're getting paid. 2,000 hours.
well, but in today's day and age, not everybody, a lot more people working from home. There's just a lot more opportunity for it to be able to do that. I mean, I walk around my office, I see people on websites, that aren't tax related. Gary, looking at guitars. But I see people all the time. So, you just don't know the situation, and it's still a stretch.
So I'm getting real stuff right now. Do you think the IRS is leaning on that person because they also work for the government?
No,
No.
they don't care.
They started off denying it
So then why?
Yeah.
So then why do you think in the end they were leaning? Just because?
because they asked for certain things. So what happened
And they
was the
had-
IRS said, "Here,
Documentation.
this
Yes.
is what we want. We're not giving this to you." And they wanted to see a log, and they wanted to see her real estate license. Well, her real estate license had actually just lapsed the year before, and she didn't renew it. So she went back and renewed it, and then provided this, and
So she was a real estate agent.
she was,
She was.
and her husband was a doctor, and so it just so happened that the IRS granted it, and we were actually kind of shocked.
Yeah.
We with confidence said, "Here you go," but then we're like, huh? So who's going to tell her that they're not going to get this? But they ended up getting it.
Yeah, because I'm like right on that bubble where if I wanted to stretch it, I probably could, but still kind of not sure if I want to.
Why would the IRS be so lenient? That's an excellent question. Excellent question. What is, number one is the United States Chamber of Commerce. What is the largest lobbying group in the country by far? Sorry?
TurboTax. Is that?
I thought it was defense.
Oh, I was thinking TurboTax.
The
It's
lo-
a lobby of the government.
The real estate by leagues over is way down there. Real estate. Why? They petition Congress. How do we know 469C7? What a boring thing. We know it because that was really driven home. Because people in real estate, no pun intended, they have a lot invested in what they're doing. These are large capital investments. They're creating homes for people, creating opportunities, and facilitating the betterment of the United States economy. And that's not mumbo jumbo. That's on the Treasury website. So why do they allow it? Because it's good for the country. So a lot of the things we might advocate for, whether it's a cost seg, whether it's a 1031A exchange, you know what? We need to discriminate. Is it right for you? How do we know? We don't. Do we need to give you? Here's what I want you to hear. Don't try to look for better answers. All right. Ask better questions. What am I doing? Why am I doing this? What was my decision-making process to enter in this transaction? Where do I think this is going? And we can work around a lot of those things. Let me throw up a few more just for fun. Must invest locally. 1031A exchanges where we take one property and flip it around. If you don't know really what that is, we need to visit. That's a really neat thing. You can flip properties in the United States, defer the gain over and over and over and over. Guess what? You can do that internationally too. Yeah. You know, here in America, we've got obviously both coasts, very expensive. In the middle of the country, right, I had to put it with the story, where my folks live, nothing. They bought their house in 1972 for $72,000. They just moved into an assisted living facility. They said, should we sell it or not? Great, it's worth 117. In all these years, that's been it. When we moved out of California and they sold it for 69, to now worth 2.97 million. Darn, why did we leave? Paris, obviously, we know all the usual suspects. Paris, London, Tokyo. Toronto is out of control. Vancouver, out of control. A lot of these things you can still do, and in this day and age, just because we're not local doesn't mean we can't be active again. I want to touch real quick and get back to your question. I want to touch on this 1031A just because when we showed of hands, a lot of folks weren't real familiar with it. And forgive the anecdote, it has relevance. When my step-grandmother passed away, my dad and my stepmother got some property. And what do we do with it? Well, rather than you get a full step-up in basis, and they hung on to it for a while. Long story short, but what really happened was, well, we're going to take these three awful properties in Winston County, Mississippi, where it's like always 200% humidity, turned it into one, a ski chalet actually in Gatlinburg, Tennessee, which made a lot of money. The Gatlinburg ski slopes like death traps, so we got out of that and transferred it to an apartment building, small one. We've done that about 9 times in 26 years. They still haven't paid. This worked out. An arm rate went too high. We're out here. How much gain have they paid in that time? 0. When they pass, step up in basis. I'll make sure it goes away. Me and my ungrateful, no good siblings, we'll split this. But the whole idea is, what's right for you? We don't know. So we have to ask. Questions, comments?
The capital gains tax that you're going to be paying is on the last property, and that's it. You're not just deferring the taxes from every single sale. You're just deferring the tax, the tax on the gain you're going to pay to the very last.
It depends. And more later. First of all, there's several different kinds of 1031A exchanges. Sometimes you may have even heard, this used to be called a starker exchange, but whatever that activity is, the gain is deferred going forward until you dispose of the activity permanently, or there's some other triggers to it. So could it be more than one? Yeah, it could. Can it really accumulate? And that's why after a while, when you do these, we own a home personally. Everybody has the $250,000 gain exclusion. But after a while, That's not even gonna come close. Just helped a client. They bought a home in McLean, Virginia, small little town here, kind of dusty, I guess. They bought it in like 1969, 3.5 acres, little Rambler style house, I guess you called it. And you know, they bought it for like 179,000. Sure, they've done some improvements, but it's still a future tear down. And the land is worth $3 million. She's like, do I still get my 250? Yeah. And where we have to come back and say, here's what we're going to do. We're going to have you rented out for a while and do, you know, we're going to have you rented for 2 years, take the Starker exchange and move it on to something else.
Sick.
What's that?
Nothing.
Oh.
Sick.
So there's times when it applies and there's times it applies damn well. So,
I have a question. So I had some move-out agreements with current tenants in the building. They're like $10,000 behind on rent, and we have an agreement that 30 or I think it's like 60 days after close, if they move out, then I forgive all of their bad rent. How is that treated for accounting purposes?
Since you're a cash basis and you never picked up the income, it really doesn't factor into anything. So you can't take a loss on that because you never picked up the income. So unfortunately, it sounds like you'd be able to take a loss, take a hit on that, but it works out in the numbers automatically because you're cash basis. Does everybody understand what that means? Okay, so you didn't pick up the income of 8,000, and now you're going to take it back and negate that. Since you never took it, you don't get that,
But
unfortunately.
it's an asset on my balance sheet, so rent receivable that I'm writing off.
But that's an accrual. So rent receivable, not to give everybody an accounting lesson, rent receivable is an accrual basis item, and you're, as a taxpayer, you're cash basis. So unless you're running it through an LC that you've elected accrual basis, but then you would have picked up the income, this phantom income before anyway. So your situation could be where, yes, you do get a benefit of that, but that means you've got a detriment up here that the benefit is offsetting, if that makes any sense.
if you didn't suffer the tax, we don't get to enjoy the deduction of the loss.
W-2 employees hoping to buy a short-term rental this year, we've heard there's substantial tax advantages to that. We're definitely not active investors, though it feels like it at times with our house act. What are the tax advantages we should look out for or expect with respect to buying a short-term rental?
I would disagree with one of your comments. You are active. You are active. Did you look at the property? Of course you did. Did you do that? Yeah. Let me make something real clear to everybody here. If you can hear my voice, turn around like this. Painful eye-to-eye contact. You're here tonight.
I'm so sorry, gentlemen. I have to skip out.
Sit the hell back.
I'll be in touch on LinkedIn. Okay, thank you. Sorry, guys.
You're here tonight. You are actively involved, not just at your W2, but in real estate. You really are. You're taking the time to get some new knowledge. I'm going to change your mind. You are an active investor. Maybe you're not a real estate professional, but you are an active investor.
What are the differences between those two? Active investor and real estate professional?
Excellent question. 2 words. Material participation. You're here. You looked at the property. You've maybe driven by it. You've done these things. Or maybe, look, we're going to Airbnb our basement or something like that. You're materially participating. Bravo. Again, is this in England that your brother-in-law is handling? No. It's right here and you're involved. You are active.
Does that impact your taxes?
I'm sorry?
Does that impact your taxes?
Absolutely it does.
Wow.
Here's our answer. You got to get used to it. You invited accountants.
It depends.
It depends. In a few things. We will be able to, as long as we don't exceed the income threshold, we'll be able to take up to $25,000 in losses. Everybody can. If we exceed it, no, we don't, and they'll roll forward for future.
What's the income threshold for married couples?
It's 150. So, here on the West Coast, we're not like my in-laws out in the Midwest somewhere. We get blown. I'm going to circle back. we get blown out of the water on a lot of these thresholds by living here in Metro DC. My sister-in-law and her husband bought Dixon, Missouri, $119,000, paid full price. Obscene. I hate them anyway. Now even more. Got a brother in San Diego. We know that story. They got a little one-bedroom condo worth $1 trillion. All these things. You aren't involved. So yes, we can exceed that. But at some point, can we take the active? Can we take losses? Do we have to defer them? And so we can do that. But we're going to change the story a little bit, aren't we? Short-term rental. I want you to throw out the word rental. Short-term hospitality enterprise. So all of a sudden, think of it on taxes. This is not going on Schedule E anymore. This is not a long-term rental as we would do some other things. It's on Schedule C. This is a business, day job. It's Amway, it's guitar sales, it's anything else you want it to be. But in this case, if you run a loss, regardless of your income, you get the loss.
Does it count against your W-2 income?
No. Yes. Yes. Sorry. I
Oh, no.
misunderstood. You
That
bet.
would be glorious.
Yes, it can offset. Let me keep it easy on my third grade math. At your two W-2s aggregate to 400,000. There's a $50,000 loss. Wow. Now we're only being taxed on 350.
That's really great.
That is really, really great. And again, things. Yes, it really is.
Taxes, where if it wasn't short-term rental on Schedule C, you wouldn't pay self-employment taxes.
So are most folks doing short-term rental on Schedule E or Schedule C?
Well, you have to do
You have to do
short-term.
it on Schedule C.
You have to do it on Schedule C, but you have to, it's great to get those losses because you wouldn't otherwise. So we have lots of physicians who own real estate. They want those losses. But when they have income, because, so all of a sudden you go to charging $30,000 a year for rent,